When our next guest speaks, investors listen. And the warning here is loud and clear. Ditch U.S. Treasuries before it is too late. Joining us right now live on the phone is Marc Faber, fund manager and publisher of the Gloom, Boom, and Doom report. Marc, good to talk to you. Tell me why you're so concerned right now about U.S. Treasuries. Unfortunately, I have heard that we just lost Mr. Faber, so we're going to check back with him. In the meantime, we have now with us Peter Schiff, president of Euro-Pacific Capital Incorporated, and CNBC's very own Sue Herrera. Good to see you guys. Peter, I'll throw the same question at you. You've got a few concerns out there about the, shall we say, health of the U.S. government and what that means for Treasuries.
Yeah, I'm sure I could speak for Marc as well. I've met him many times, and we agree on this. But, yeah, I mean, the bond market is the mother of all bubbles right now, and I think when it bursts, the losses will dwarf the combined losses of the stock market bubble and the real estate bubble. You know, the problem is there is no way for the government to pay this money back. The only way they could do that would be tax increases that are just horrendous and would never be accomplished, or the government's going to have to tell people on Social Security or Medicare that they're not going to get their checks because the government needs it to pay interest on the debt. And it's not only paying the interest. What I'm afraid is that when people realize that we can't pay this money back, we're not going to be able to roll over all this short-term debt. And so it's not just paying the interest. We're going to have to start retiring the principal. And that is just impossible.
Well,
so there's going to be massive inflation.
What about this theory that we might inflate our way out of debt?
But you don't inflate your way out. I mean, maybe from the purpose of the government, but the people who hold the bonds,
right,
they're getting their purchasing power inflated away.
But Peter,
that's where the losses will come.
The Fed has just told us that they will continue to buy Treasuries. They're going to try and fight deflation, and they will do that by continuing to buy Treasuries. The individual investor took out $33 billion out of stock market mutual funds in the last 7 months or so. I know you're very familiar with that because they want the return of their money. They don't care whether they're even making any return on their money. They are so adverse to equities. I agree with you, the bond market trade is very crowded right now. But until the Fed signals that it's going to do a de facto tightening, or until the individual investor is willing to put themselves out on the risk curve, they don't have any place else to put their money other than in the mattress or in U.S. Treasuries.
Well, there are a lot of places to put it around the world that are a lot safer than lending money to the U.S. government. But, you know...
Well, they're putting it in corporate bonds. You know, whether you're talking about Treasuries or corporate bonds. We've had the biggest issuance of corporate bonds this month that we've had in some time, and they're getting a decent yield. But they're not willing to buy the equity, even for the dividend.
Yeah, I know. People, if you go back 10 years ago, where was all the money flowing? U.S. investors were piling money into stock market funds, and then we had the worst 10 years in the history of the stock market.
And
they're making the same mistake with the bond market. That this decade is going to be the worst decade for bonds in U.S. history. Bondholders are going to get wiped out. I mean, because either the government's going to default or they're going to inflate. But either way, the people holding the bonds are left holding the bag.
How much time do you think is left in the bond market? I mean, I do agree with you with it's a crowded trade, but until we get the risk aversion problem out of the way, and until the Fed backs off, how much time do you think is left?
What has to happen is people have to understand where the risks are. If you really are risk adverse, you don't want to own Treasuries. You want to own gold, you know, or if you want to own Treasuries, own them in Switzerland. You know, own them in some other country where the government is not as reckless as this government.
Okay,
and it's a question of
joining us via phone right now is Mr. Marc Faber, fund manager and publisher of the Gloom, Boom, and Doom report, I should say. Mr. Faber, good to have you with us. We've just been talking about this whole issue of U.S. Treasuries, whether or not there's a bubble. You say yes. Why?
Well, basically, I think that there isn't much upside potential in Treasuries unless it's for the short term. And even the short term is uncertain. But if I look at 10 years ahead, where do I want to have my money? Then certainly not in U.S. Treasuries.
Well, why? What is your big concern here? Is it the fundamental...
My biggest concern is that because of a weak economy, the deficits, the budget deficits, the fiscal deficits will remain very high. And with Mr. Obama as a president, I think there's a very good chance that the deficits will actually go up. As a result of that, the government debt will expand and expand, and one day the interest payments on the government debt will become unbearable.
You know, but Mark, a lot of people keep saying that. It's a scenario that we've heard certainly time and time again, and yet when you look at the actual landscape out there, foreigners always seem to want to keep buying our debt. We've seen a little bit of slack off, though, lately
I agree
with the Chinese.
In 1999 and 2000, foreigners also wanted to buy the NASDAQ. And what happened after is a major collapse. I would not look at foreign buying as a very intelligent leading indicator. Moreover, if you tell me to buy U.S. government bonds, they have been rallying since 1981. In other words, we have a 19 years rally. I'm not particularly interested to invest in an asset class that has been in a bull market for 19 years. Then I'd rather buy an asset class, whatever it is, that has been in a bear market for 10 or 19 years.
So what is the better place for an investor's dollar right now?
Well, I think I would buy essentially farmland, and I think agricultural commodities will continue to be strong. And as the previous person said, I think that gold belongs in a portfolio.
You know, I have with me my colleague Sue Herrera. We also have Peter Schiff. Peter, of course, agrees with you. He was just sort of outlining a similar argument. Sue is on the other side of this equation, so I'm going to let her voice what she was saying earlier.
Well, basically, gentlemen, I think one of the issues that we have is it depends on which investor we're talking about, the individual investor or the institutional investor. And I agree with Peter and I agree with Mark to a certain extent that the Treasury trade has gone a long way. But if you look at the risk aversion for the individual investor, they still remember the lost decade for stocks. They still remember the NASDAQ bubble. And even though there is a crowd in the Treasury market, they still want the return of their principal rather than the return on their principal.
There's no question that people are making a mistake here. You know, they're jumping out of the frying pan into the fire. Americans are saving more money now, and we need that. We need extra savings, but unfortunately, the savings are being loaned to the government and not the private sector. You see, the government is not expanding the economy with this money. They're not investing in productive capacity, so the tax base isn't expanding.
But
they're actually making the economy weaker, and so we can't pay the money back.
How long do you think we have until, if indeed the Treasury market is in a bubble, until it bursts, with the Fed just recently saying we will continue to buy Treasuries?
If I could answer that question, I'd be on my yacht in the Caribbean.
Hang on one second. We just want Mark to respond to what Sue was saying earlier and sort of the time horizon that we may have here.
My view is that the Treasury market bottomed out on September 21st, 1981, when yields went over 15.84% on the 10 years. Then we went down in yields on December 18th, 2008 to 2.08%, and on the 30 years to 2.53%. I think that was the peak of the bubble. I don't think that interest rates on the 10 years and 30 years will go lower than we were on December 18th, 2008. And I have a bet outstanding with David Rosenberg about this.
All right. We're going to leave it there, I think. Gentlemen, thank you very much, and our very own Sue Herrera. Appreciate it.
My pleasure.